Everyone talks about investing in gold and silver as if they're the same thing. But what if I told you this common mistake could be silently costing you thousands? What if lumping them together is like thinking a lion and a house cat are the same animal, just because they're both felines? The truth is, silver's price behaves almost nothing like gold's. In the next few minutes, I'm going to show you the key differences in industrial demand and market volatility that the pros use to their advantage. We'll break down why one is treated like a monetary lifeline, while the other is a strategic commodity powering our future. We'll look at why silver's price moves can be so much more dramatic than gold's. And I'll give you the one simple metric, the gold to silver ratio, that can act as your personal barometer for spotting relative value. Understanding this isn't just trivia. It's the key to deciding whether you are ensuring your wealth or speculating on the next technological boom. Let's be honest, it's an easy mistake to make. For thousands of years, gold and silver have been intertwined in our collective psyche. They were both money dug out of the ground, prized for their rarity, and sold in coins and bars. When faith in paper currency falters, they're both tangible assets you can hold in your hand. They are both precious metals. And for most people, that's where the thinking stops. But that surface-level similarity is a trap. It creates a dangerous blind spot. After years of analyzing a market, it's painfully clear their paths are diverging more dramatically than ever. Gold is playing its ancient role as a store of value, a monetary anchor in a sea of uncertainty. It's what central banks buy when they get nervous. But silver now has a secret identity. While it still has a role as an investment, its destiny is now tied to something else entirely: global industry and our technological future. That is the single most important factor that makes its price act in a completely different way. Here is the most critical difference. What drives demand? For gold, investment and jewelry are everything. The vast majority of gold demand comes from these two sectors, with a much smaller fraction, less than 10% in 2024, being used in technology for things like specialized electronics. Gold is valuable primarily because we, as a society, have collectively decided it is. It's almost a pure monetary metal. Silver is a completely different beast. It leads a double life. While it is an investment asset, over half of all silver demand comes directly from industrial fabrication. In 2024, industrial use accounted for around 60% of total global silver demand, hitting a record high for the fourth consecutive year. Silver isn't just sitting in vaults. It's being actively consumed by the technology that defines our world. Think about the device you're watching this on. It has silver in it. Silver is the single best electrical and thermal conductor of all metals, making it irreplaceable in electronics, circuit boards, and semiconductors. But the real story is the future. The green energy transition is fundamentally a silver story. Every solar panel contains silver paste that conducts electricity. This sector's demand for silver has exploded, with one report noting it grew from just 11% of industrial demand in 2014 to 29% by 2024. As the world pushes for more solar capacity, the demand only grows. Then there are electric vehicles. An EV uses significantly more silver than a standard car, and with the EV revolution accelerating, this is a huge source of new demand. In fact, some analysts predict that EVs will become the primary source of silver demand in the auto sector by 2027. From solar panels to EVs and the data centers powering AI, silver is a strategic commodity. This means its price isn't just tied to inflation fears. It's tied to global GDP, manufacturing output, and the race for new technology. So, what happens when a metal is both an investment and a consumed industrial good? You get volatility. Lots of it. Silver's price can swing 2 to 3 times more wildly than gold's on any given day. It's not for the faint of heart. Here's how to think about it. During an economic boom, when factories are humming, the industrial demand for silver surges. This can cause silver's price to skyrocket, often dramatically outperforming gold. We saw a stunning example of this in 2025, when silver prices surged as this powerful combination of industrial and investment demand collided with tight supply. But this is a double-edged sword. In a recession, the opposite happens. Factories slow down, and industrial demand for silver can collapse, causing its price to fall much faster and harder than gold's. Gold, on the other hand, glides. With its limited industrial use, it is far less affected by economic cycles. In fact, during recessions or times of geopolitical stress, gold often shines as investors flee to it as a safe haven store of value. It is consistently uncorrelated to the stock market, which is its primary role in a diversified portfolio. So, when you buy gold, you're primarily buying stability. When you buy silver, you're making a more speculative bet on industrial growth, with both higher potential upside and significantly higher risk. They serve two fundamentally different purposes. If you're starting to see how this difference could radically change your investment strategy, do me a favor and hit that subscribe button. And let me know in the comments, are you more focused on gold stability or silver's growth potential? I read all the comments, and I'm curious to see where you stand. Now for a tool the pros use, the gold to silver ratio. It sounds complicated, but it's incredibly simple. It's just how many ounces of silver it takes to buy 1 ounce of gold. If gold is $3,000 an ounce and silver is $30, the ratio is 100 to 1. Why does this matter? Because it gives you a sense of relative value. To make it practical, here's a simple benchmark framework. When the ratio is above 90, it often signals crisis-style pricing. Like in 2020, the ratio can blow out to extreme highs. This happens because investors pile into gold and dump silver, making gold extremely expensive relative to silver. A high ratio is often seen by contrarian investors as a signal that silver may be undervalued compared to gold. When the ratio sits in the 70 to 90 range, it's still generally a gold-strong, silver-weak environment. The 50 to 70 zone is often closer to a balance range, where the market's relative pricing between the two metals is more neutral. If the ratio compresses into the 40 to 50 range, that usually means silver is materially outperforming gold, often because the industrial narrative is stronger, risk appetite is improving, or silver momentum is taking over. And if it pushes below 40, that's often a sign silver is entering an overheated regime, where volatility can accelerate sharply. Now bring that thermometer to today. The ratio is roughly around 48. The message is clear. Silver has been priced at a higher relative premium and is meaningfully stronger versus gold right now. A low ratio might signal that silver has become overvalued relative to gold. It's not a crystal ball, but it's a powerful barometer for understanding market sentiment and the relationship between these two very different metals. So let's connect the dots. Saying you're investing in gold and silver is like saying you're investing in Apple and oil. Both can be valuable, but they're driven by completely different forces. Lumping them together is a huge mistake. Gold is your portfolio's insurance policy. It's a stable, non-correlated asset that shines in times of fear and uncertainty, largely disconnected from the swings of the industrial economy. Its value is monetary and historical. Silver is your portfolio's speculative growth engine. It's a high beta bet on the future of technology, electrification, and global manufacturing. Its price gets whipped around by economic cycles, offering explosive upside during booms and painful downside during busts. Its value is increasingly industrial. If you found this breakdown useful, make sure you're subscribed with notifications on, so you won't miss my next video.